This is Dave Wagner at Tidecrest Wealth Management. Thanks for joining us for the Tidecrest Expert Series. Today we're fortunate to be joined by Clinton Maines from Hartford Funds, going to talk to us about long-term investment themes. Clinton, why don't you tell us a little bit about Hartford and Wellington and how these themes kind of came to light?
Yeah, thank you, Dave, for having me. Really appreciate it. So my role, I am the advisor consultant covering Southern California for Hartford. I joined the firm in 2011, so it's been about 14 years now. And we're really fortunate at Hartford Funds. We've got about 130 billion in assets under management, been around since 1996. But I think our big key is we're able to tap into our investment sub-advisors like Wellington Management and Schroders. Both of them over $1 trillion in assets under management, been around each over 100 years. And I just love being able to tap into their thought leadership and their investors and really bring that to my advisors and their clients as they're looking to make decisions for portfolios.
I think it's interesting to understand how Wellington kind of fits into the mix, and tell us about how they come up with their future themes.
Yeah, I think with investing and with the markets, we can be very caught up in the day-to-day changes, right? It's constantly evolving. We can see, right now especially, what I love about Wellington is I think they try to see the forest through the trees.
Right.
And, they're really looking at what are these kind of underlying trends or future themes that are emerging, maybe not tomorrow, but, the next 5, 10, 15 years that are going to help shape, our thesis on how we're going to be investing clients' portfolios going forward. So every market cycle, few years, they kind of survey all the investors along Wellington, over 600 people, and really ask them, hey, what are the things that you think are going to be relevant and coming on to the scene that are going to be important for us to take a look at or pay attention to.
Right.
And so what they do is they kind of take those top themes, answers that they get, and they compile these future themes that we share with our clients and investors. So it's really interesting.
It's great. And thanks for sharing it with us today. We're excited to do it. So let's dive right in. So first one is, what larger deficits mean for growth, inflation, and next generations as we continue to build up national debt? As everybody knows, right, this is kind of in the news right now, U.S. government continues to borrow at an increasing rate and run fiscal deficits, right? We're now at a percentage of debt to GDP that some people are getting concerned about. Mm-hmm. What does that really look like for investors and future generations, as we navigate, this landscape?
Yeah, I mean, it's no secret, right? The government continues to spend more and more. The deficit and the federal debt continues to grow. It's something that we are plain and simply spending more money than we're taking in on tax receipts, and it's been that way for the last 20 plus years. However, if we think about what the environment looks like, we were in an environment up until recently where interest rates, inflation were relatively tame and modest. And so I think that kind of muted or at least, put a lid on some of the concern with that debt. But now, as we kind of enter this new world where inflation maybe stays a little stickier, a little higher, and interest rates are higher than maybe the last 20, 30 years,
sure.
That brings to a lot of questions on the sustainability of the debt.
So what are their thoughts? So, how do they feel like investors are going to navigate this new future, right? I mean, larger deficits and larger national debt and more expensive, carry of the national debt, which is what you're referring to when you're talking about rates going up, right? So now you're talking about a debt that just costs more,
right?
So it's going to be, effectively higher spending for the U.S. government. So what are they saying? What is your firm saying, Wellington saying about, how do we navigate that world?
Yeah, I put a statistic in here on one of the charts, but as of January of this year, it's going to cost about $392 billion just to service that debt, right, that we have on the books. And that's about 16% of federal government spending overall. Right. And so the way I look at it, and I think we talked about, is you tie it into kind of similar to a consumer balance sheet, right? If you have a household that continues to spend money, racks up credit card debt, whatever it may be, that payment isn't eating into the principal as much, right? It's just paying that interest that you
sure.
have. And there comes a point in time when that it's going to affect your credit rating, right? So that is the big concern that the investors of Wellington are thinking about, is at what point does this start to creep into investors, to central banks, other foreign governments' mind of what is sustainable to lend to the U.S. government at. And that's kind of what's going to control interest rates for the long term, in our opinion. I think the actionable idea, or what the point that they were trying to make, or that we're even saying right now, is that inflation and interest rates are going to be much more volatile, right? They're going to be much more unpredictable. So I think we have to be cognizant of that as investors,
Right.
as we're allocating capital and buying, fixed income, whatever it may be,
Yes.
equities, that is going to be something where we've taken for granted the last 30 years that we've been in a declining interest rate environment and a low inflation. We've kind of imported deflation from China. Is that what they,
Right.
That's going to no longer be the case. So I just think cycles are going to be shorter. They're going to be faster. They're going to be more volatile. And I think we have to be, ready for that as investors.
But that was perfect. Just be aware.
Yeah.
Like what we've experienced the last 30 years with declining interest rates and,
Right.
Inflation really hasn't been on the radar for over a decade. I mean, it was almost, 0 to 1 and the target was 2 for quite a few years in between financial crisis and now. So I think that's the takeaway is like, hey, we're in a little bit of a new environment. People are feeling that, right?
Yeah.
Especially when the Fed last year came and said, hey, we're probably not going to cut rates that much next year. Then their December meeting, of course.
Yep.
And the market did not like that.
Correct.
Right. And so I think originally the thought was 2 to 5 cuts in 2025, and the vibe was like, well, maybe we'll get 1.
Right.
Right. And so I think people are realizing these rates are maybe a little bit more here to stay than they expected.
Yep.
Inflation clearly is being a little more stubborn than people maybe anticipated in
Right.
general. So yeah, I think it's a good way to think about it.
Yeah.
Going forward. Moving on to the next theme. This one's interesting. Longevity's effect on consumers. What does the average consumer look like in 10 to 20 years? So look, it's no secret that we have an aging population in the United States. Along with that, a lot of things are tied into that, right? Social Security, Medicare spending like that, and consumer spending. As we know, consumer spending is about 2/3 of U.S. GDP. And so that's a really considerable piece of performance for the economy, U.S. economy. Yep. So what does it look like as you're evaluating consumer spending 10 to 20 years down the road in a new environment where people are living longer? Give us a feel for what Wellington's saying about that.
Yeah, I think this is a big theme that's been emerging for a while now. And you can reference the slide that we showed as well, right? That on the next page. But it's, we have over 10 to 11,000 people turning 65 every day, right? So if you think about that hourglass of population growth, it is the fastest growing cohort. And, that is going to bring implications, like you said, from a spending standpoint, right? More people retiring, leaning on social programs like Social Security, Medicare, how are those going to be replaced? But at the same time, where is that younger generation going to come from to be able to create that, that next generation of productivity? Mm-hmm. So what I think is what we're really focused on here is there are emerging trends that we can take advantage of as investors. And I really tap into things like the MIT Age Lab that we're one of the founding partners of in Cambridge, Massachusetts. A man named Dr. Joe Coughlin, who's the founder, he wrote a book on something called the longevity economy. And he really thinks that businesses and enterprises are missing out on what he thinks is this growing trend of the baby boomer generation, right? This aging 60 and older cohort. He says that in the next few years, there's going to be over 1 billion 60 plus year old consumers out there in the marketplace. And that is, tends to be very good opportunity for businesses because what do folks who are retired tend to have, right? They have wealth, they built up, that type of spending power, right? Like you were talking about it. So, he thinks the future looks very different from an age standpoint, very female dominated. And that's where, I put the statistic in there as well. Only about 15% of businesses right now have a target or a business section that focuses on an aging consumer base. Right. So, we work with countless businesses. The MIT Age Lab works with countless businesses that are really trying to redesign their products, services to what they think is kind of a changing demographic going forward.
Sure, that's interesting. Yeah, so it's good. I mean, I like the idea of that, and I think you see that in some industries already, right? And I think the idea that we're going to move more and more in that direction of targeting those folks that have accumulated wealth that are older and that are healthier and able to consume in maybe a different way that they have in the past. That's great insight.
Yeah, I mean, if you look at specific industries, right, where you think of elder care, right, these retirement care communities, healthcare services, products that are geared towards, medical treatments for folks that tend to have more ailments as we age, and then even smart home technologies, right, things that we can put in our homes to allow us to stay there, longer, right, and live healthier and safer. So that's really a trend that we see, taking place.
Absolutely. Yeah, that's great. We're going to move on to the next topic, which is automation and robotics. Clearly, this is an area that everybody can see happening in real time, right? AI and the ability to kind of change robotics, and you see those moving forward together in an irreversible way, right? We're gonna follow that path. It depends on where it goes.
Right.
So let's talk about it from an investing perspective. So what are you guys saying?
Yeah, so I think there's a few areas that you can highlight there, right? So traditionally, we think of things like factory automation, collaborative robotics. That's humans and machines working together. So I always say, think about an automotive plant, right, where you see some of those machines that are helping individuals, assembling cars, things of that nature. That continues to be, more and more prevalent. But I now, like you said, with the development of AI and kind of this machine learning, there are certain tasks that we think can help, program or help these robots learn and be able to perform those tasks that used to have a human oversight. And so, that's going to help from a productivity standpoint. It's going to help from a cost input standpoint, from a labor standpoint for companies. And so that's something that we think is going to be a big driver in the next few years of an investment theme. So
yeah. What do you think about, I mean, this is something, that you have it on here as a social labor implication. Will robots take our jobs, right? So talk about that a little bit.
Yeah, so I think that's the big question mark, right? Is will the robot take my job? Is it going to be able to do what I do now better than what I do? Yes and no. I don't think we're going to see, robots take over people's jobs for the most part. There are going to be certain skilled, laborers that are going to need to be retrained or evolve in order to, stay relevant. Yeah. But I look at that in any field, right, or in any study that we do. So I think the advancements will help, like I said, productivity, GDP. They'll help create wealth, and I do think that it will create new fields that will, open up for an employment or entrepreneurs to take advantage of. So we kind of see it as, you have to give a little to get a lot, and that's what's going to happen.
Yeah, great insights. So let's move on to the last one. Water scarcity, how commodity prices could rapidly change and how water scarcity could lead to geopolitical conflicts. So this seems, again, like maybe this is a topic that has come and gone a little bit over the years. It does seem intuitive. There's certain areas that, access to clean drinking water. But this is an area I haven't really spent any time thinking about in terms of like an investment theme. So tell us more about that.
Yeah, I think it plays twofolds here, right? So number one is you look at kind of geopolitical relations and you look at conflicts around the world that are becoming more and more prevalent. I think there's something like 200 conflicts right now going on in the world currently. That's a very high number. So, when we think about, U.S. in the economy and how we're going to protect ourselves against, foreign entities and threats and rivals that are starting to come onto the scene, these are a lot of things that have to do with how we're going to compete over natural resources. And so, water, I would argue, is probably the number one, natural resource in the world. I wouldn't argue it is, right? Our bodies are 97% made up of water. It is vital to all life and being. And so I think the access to clean water or the lack of is going to be very, very critical because right now, the demand is far outstripping the supply, right? So we're going to need to be able to find newer ways to access that clean water.
Yeah, there's an interesting chart you guys we'll put up here too about freshwater withdrawals as a percentage or as a share of internal resources. You kind of see some of the trouble areas, right? Some of the tricky areas. So I don't know if you want to talk about that chart at all. You don't have to. I just don't.
Yeah, no, absolutely. I mean, it's a lot of things you would think about, right? The sub-Saharan, kind of corridor, but even the United States, right? I think you look at us and we're utilizing more and more of our fresh natural resources every year. Yeah. What does that do? If you look at things like climate change, that's going to affect where the lack of rain or when it does rain, it's going to rain harder, right? Just the velocity. Sure. That's going to affect everything, right? Agriculture, crop yields, natural resources. And so what we're saying is that those are going to become more and more prevalent. It's going to be much more big swings in those type of prices for goods and services. And we just need to be cognizant and aware of it. And you're even starting to see things like water futures traded on, futures exchanges now, which, I just thought is very interesting there. So it's just something where, if you look at it, 60% of natural fresh water is on transboundary rivers and lakes or bodies of water. So, who has claim to that, right? It
Right.
means, who has the claim? And so that's where I just think you're going to see more and more competition, which could lead to conflicts and obviously, like I said, higher or more volatile commodity and agriculture prices.
Sure. So what is it? Is there a takeaway for investors kind of as they think about this as a theme over the next market cycle or more? I mean, one of the charts here shows where water stress will be the highest by 2050. So clearly we're looking at more than one market cycle. But how do investors look at this? Is there something they should be specifically considering in their portfolios?
Yeah, I think, if you look at non-traditional stocks and bonds, we really need to be looking at those other areas of the market, right? When you think of hard assets,
Sure.
precious metals, the emergence of things like crypto, these are things that people are really going to put an onus on because of the fact that these natural resources are being used up and there's fewer and fewer,
Right.
and they're going to be more and more competitive. So we always think folks should have an awareness there of looking to put a portion of their portfolio from that standpoint.
Sure, absolutely. Well, thanks again for taking the time. I want to say thanks for all the viewers for tuning in. Once again, this was the Tidecrest Expert Series with Clinton Maines from Hartford Funds, talking about investment themes that we're looking at over the next multiple market cycles, right? And we just wanted to say we appreciate your time and expertise. And until next time, thanks for tuning in.
Thank you.